Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Paris milling wheat and London, UK feed wheat.
Paris milling wheat. The market here in August, as elsewhere, constructed a new pattern. It built a mid-August to mid-October ascending wedge pattern, highlighted in dark blue on my daily chart. In mid-October, prices dropped out of this ascending wedge pattern and pushed down through all the moving averages. In this move lower, this market showed an earlier bearish incentive compared to the other grain markets. So, there were here, as elsewhere, avenues for prices to travel, and it chose a straightforward move down with appropriate potential targets for the ascending wedge pattern. A primary target down in the 331 zone, whilst a secondary harder to reach target was way down in the 296 zone. The primary target was easily achieved, but it took until mid-December to reach the secondary target, which in its way is actually an achievement, as none of the other grain markets has managed to reach a secondary target before then. So where does that leave us now? Well, I pondered on this 10 weeks ago, and I quote, "Take a look at the whole big action since the peak in May to date as just possibly, a very, very large bearish halfway hesitation in the making. To clarify, it is possibly in the making and it's not made, not yet. This is a ginormous pattern and one which will eventually leads down to something like the 225 area. I'm not prepared to call it that, not yet. However, we may have another bearish but less aggressively bearish pattern, though not necessarily by much. It is a mid-June to date bear channel, currently at 248 to 324, which is highlighted in bright green on my daily chart. I'm not saying either of these two will be the way forward, but if you favour the bearish side, these are worth considering." End of quote. These patterns still stand, and both have merit. To these I added 5 weeks ago a further short-term pattern, and one that initially worked pretty well. It was a mid-November to late December last year bearish Andrews pitchfork. However, on Monday 3 weeks ago, prices punched up and through the upper time, which prompted me to retire the bearish Andrews pitchfork and instead utilize a shallower bearish shift pitchfork for the same move, and which you can see highlighted in purple on my daily chart. This had previously been breached but has repaired itself, and in the last 3 weeks we have seen the market test the upper time, currently 284, the middle time, currently 273, and most recently the lower time, currently 261. Say what you will, this bearish shift pitchfork has been excellent at showing the recent bearish angle of attack. We have supports below and resistances above, but I won't bore you with listing them. Just look at the purple lines for inspiration. And it isn't broke, don't fix it. London, UK feed wheat. In mid-October last year, the market made a weekly key reversal down that broke down through the lower bull channel line of the August to October 2022 move and started what was at the time the next major piece of action, a move lower which included breaking down through all the moving averages. This left this market, as elsewhere in the other grain markets, for choice of avenues going forward. Eventually the market chose, as I described it 13 weeks ago, and I quote, "a straightforward move down with potential targets for the break below the bull channel." In this case, a primary target on the downside was already achieved in the 269 zone, whilst the secondary harder to reach target X1 is almost achieved in the 239 zone. End of quote. Prices finally dropped down in early December and reached the secondary target in the 239 zone. I also laid out 13 weeks ago the next possible scenario, and I quote, "We now have to see if the 239 zone will hold this decline, which includes the previous all-time high at 238 3/4. If it doesn't, then there is a series of old congestions, some dating from 2012 between 230.10 and 223.10, and another dating from 2013 between 215 even and 217.80. These may in turn be in the frame, but first let's see what the 239 zone holds in store." End of quote. Once reaching 239, prices hesitated, but in early January, they resumed their journey lower. It is at this point that I will bring in my last words from 12 weeks ago of what was at the time a new pattern, and I quote, "There is one potentially new factor to add into the mix. I'm even not sure if it is genuine or not as yet, but we may have an October to date small bear channel. The one thing it has in its favor is that the short medium moving average, that's currently at 224.70, seems to be paralleling it. End of quote. 5 weeks ago, I added a shallower amended bear channel, which you can see highlighted in bright green, as it seemed a better fit at the time because of the breach above the upper bear channel line of the original bear channel at the end of 2022. This looked to be a good fit, but 2 weeks ago also, the top side began to be attacked with a weekly key reversal up. Initially, it saw prices punching up through the short medium moving average, but then the market punched up through the shallower upper bear channel line, as well as a 2012 high at 227.30, plus other congestion. This was more than just a warning, as the move up was not repaired, and thus both bear channels will be potentially relegated next time. Then, yet more happened. As the market punched up through the declining short medium moving average, currently at 237.35, yet after making it through higher, the old previous all-time high at 238.80, that capped the rise and prices dropped down to even lower levels than we have seen before. Thus we have now the lowest lows since the start of 2022. And it still looks like it may be heading lower, as the only real support that pops out is the March 2013 high at 205.05. It is at this point that I will introduce Target X in the 180 even zone below. You see, I asked the following question back late last year, and I quote, "What if the action since mid-May today is a huge bearish halfway hesitation? A really, really big one. In that case, we would be looking at potential down in the 180 even area. Yes, 180 even. I'm not as yet advocating this as a pattern, but it might turn out to be so. It will depend on how the market treats the congestion below between 230 to 223 and the smaller ones below between 215 to 217.80 and between 205 to 206.40. Watch carefully, especially the integrity of the bear channel in purple." End of quote. 5 weeks ago, I decided to place potential Target X in the 180 even area. What is interesting about Target X is that it is right by the 50% absolute Fibonacci line at 180.5.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.